Everyone is looking at the headline, UnitedHealth down 21%, but the real danger is not the stock. The real danger is that America just got a preview of how the next decade quietly breaks the business model behind your retirement account, your employer, health plan, and the safe blue, chip dividend portfolio your parents were told to trust. And here's the contrarian truth most people will miss. This drop doesn't just destroy wealth. It reorganizes it. It creates a bargain table for the people with patient capital, political context, and the ability to hold their breath while everyone else panics. Let me say it plainly. When a company like UnitedHealth, arguably the most institutional healthcare compounder in America, guides to its first annual revenue decline in nearly 4 decades, that isn't a company story. That's a system story. Because UnitedHealth didn't just miss. It collided with 3 forces at once: reimbursement math, utilization reality, and trust damage. Trust from regulators, trust from seniors, trust from the market. And when those 3 forces converge, the market doesn't do nuance. It reprices. Violently. Now, here's what the average person hears. Revenue down 2% in 2026, from $447.6 billion to above $439 billion. That sounds like a rounding error. 2%? In a business this large, who cares? But the wealthy hear something different. The machine is slowing. And when the machine slows, the hidden leverage inside the model, policy leverage, margin leverage, multiple leverage, reverses. That is how fortunes evaporate. Not in the headline, in the mechanics. So if you're watching this because you're asking, is this a buying opportunity? Understand what you're really asking. You're not asking about UnitedHealth. You're asking whether the rules of the game are changing. And yes, quietly they are. Here's the stake. This news is the kind of event that can crush the average investor twice. First, through price, because they panic at the bottom. Second, through narrative, because they get convinced healthcare is broken and they never come back in. Meanwhile, the people who actually run large pools of capital, pensions, sovereigns, endowments, don't think in headlines. They think in probabilities. They don't ask, what happened today? They ask, what is now structurally different? And in a few minutes, I will show you the one specific data point that proves why this collapse was not only predictable, it was inevitable. But first, we need to understand the trap. Because the trap isn't in the earnings print. The trap is in what UnitedHealth represents. For decades, UnitedHealth was the market's healthcare answer to a utility: steady growth, massive scale, diversified earnings, the Optum engine, the Medicare Advantage flywheel. It was the kind of stock that professional portfolios hid behind, the kind of stock that let people feel safe while taking risk elsewhere. And that is precisely why the reaction was so brutal. When the market loses faith in a safe stock, it's not selling the quarter. It's selling the idea. Let's walk through what actually happened. UnitedHealth forecast 2026 revenue above $439 billion, down about 2% from 2025's $447.60 billion, and below consensus expectations of $454.6 billion. That's the first annual revenue decline forecast in nearly 40 years. That phrase, nearly 4 decades, is doing a lot of work. It signals a regime change, not a bump. It tells investors the old playbook is no longer guaranteed. Then you layer in the Medicare Advantage reimbursement reality. The recent U.S. Medicare proposal increased 2027 Advantage plan payments by only 0.09%. Wall Street expected something closer to 6%, especially after a 5.06% rise for 2026. In other words, the market was pricing one world, and Washington handed them another. That mismatch doesn't just hurt UnitedHealth. It hits the entire Medicare Advantage complex. Humana down 20%, CVS down 10%. Sector contagion is never really about sympathy. It's about shared exposure to the same policy math. And then there's the medical care ratio. UnitedHealth's full-year MCR rose to 88.9% from 85.5%. That's an enormous move in insurer terms because it means a bigger percentage of premium dollars are being consumed by claims. It came in slightly below expectations of 89.1%, but that's not the point. The direction is the point. And 2026 guidance at 88.8% is still above estimates. Now, I'm going to translate that into human language. Imagine you own a grocery store. For years, you bought goods for $85 and sold them for $100. Then suddenly your costs jump, so you're buying goods for $89. Your revenue might still look fine, but your profit pool just shrunk dramatically. If your cost creeps up another point or two, your business model changes. That's what an MCR shift is. It's cost inflation in the only line item that really matters. And when costs rise while reimbursement growth stalls, management has only a few levers. CEO Tim Noel essentially told you what those levers are: benefit reductions, premium increases, and plan withdrawals. like the pullback from 109 counties affecting 180,000 members. Read that again. A company built on scale is talking about retreat. That's not a headline. That's a signal flare. Now add the operational and regulatory overhangs. The Change Healthcare hack, estimated to have impacted revenue by $799 million. Department of Justice investigations into Medicare billing and Medicaid discrepancies. Increased utilization across various lines. This is not one storm. It's multiple storms colliding. And this is where the average investor gets emotionally tricked. Because they'll look at one line, like adjusted EPS was $2.11 versus $2.10 estimated, and think, it beat. So why did it crash? Because the market isn't trading the past. It's trading the shape of the future. And the shape of the future is what changed. Now, I promised you I'd explain why this destroys the average person's wealth but makes the rich richer. Here's how. Most retirement flows are automatic, 401, contributions by indices every 2 weeks. Pensions rebalance quarterly. Target? Tate funds shift mechanically. When a mega cap like UnitedHealth drops 21%, it triggers forced behaviors across the system. Risk models recalibrate, volatility budgets tighten, factor exposures get reduced, and passive flows don't decide anything. They just reflect the new. Weights. The average investor feels the loss but has no control over the mechanism. They sell because they feel pain. The wealthy, real wealthy, often do the opposite. They use volatility to buy future cash flows at a discount, but only if they understand whether the discount is temporary or structural. And this is why this moment matters. Because UnitedHealth's discount is not just fear. Part of it is a repricing of structural risk, which leads to the open loop I promised. In a few minutes, I will show you the one specific data point that proves why this collapse is inevitable. But first, we need to understand the trap, the Medicare Advantage illusion. For years, Medicare Advantage was sold as the growth engine. Demographics, aging population, government, subsidized premium streams, and analytics, driven care management. It looked like a perpetual motion machine. But Medicare Advantage is not a free market. It is a contract with the federal government. And contracts can be rewritten. The industry implicitly assumed reimbursement would keep rising at a pace that covered utilization creep. That assumption is no question. Here's the trap. In good years, Medicare Advantage looks like innovation. In tight years, it looks like price controls. And when Washington tightens, companies are forced to make choices that are politically painful and commercially disruptive. Reduce benefits, raise premiums, exit counties. So when you see a 0.09% proposed increase, you're not just seeing a number. You're seeing leverage being removed from the system. Let's start with the numbers everyone quotes, and then move to the numbers that actually matter. The market saw revenue guidance for 2026 at above $439 billion, down from $447.6 billion in 2025, missing consensus expectations of $454.6 billion. The market also saw adjusted EPS dynamics that look, frankly, confusing at first glance. Fourth quarter adjusted EPS at $2.11, slightly above estimates, but dramatically down from $6.81 a year prior. Full year adjusted EPS $16.35. Now, I'm not going to pretend those EPS figures are directly comparable without context. Healthcare earnings can swing with one-time items, timing, and accounting treatments. But the market doesn't need perfect comparability to make a decision. It needs direction, credibility, and forward trajectory. And in this update, the forward trajectory got complicated. Management tried to put a floor under the narrative. CEO Steve Hemsley returned after the departure of Andrew Whitty, highlighting palpable momentum, projecting 2026 EPS exceeding $17.75, basically in line, slightly above the $17.74 average estimate. So why didn't that calm investors? Because the market is no longer debating the next quarter's EPS. It's debating the durability of the Optum engine and the predictability of policy-driven margins. Think of UnitedHealth as two businesses stitched together, the insurance side and the services side, Optum including PBM. If the insurance side gets squeezed by reimbursement and utilization, the services side is supposed to stabilize and expand margins. That's the story investors have been paying for. But commentary on near-term pressure in Optum and lower margin assumptions is what moved the needle. That's the phrase you should not skip. When the stabilizer starts wobbling, the market reprices the whole structure. Now let's talk about Medicare reimbursement like adults, not like pundits. Medicare Advantage payments are not just rates. They are the oxygen of the model. And the proposal to increase 2027 Advantage plan payments by only 0.09%, after Wall Street expected something like 6%, isn't a miss. It's a shock to the assumptions embedded in valuations across the sector. Here's the analogy. Imagine you own an apartment building where rent increases are controlled by the city. You bought the building assuming you'd get 6% rent increases. Then the city announces next year you can raise rent by 0.09%. But your maintenance costs, labor, insurance, utilities, those still rise. What happens? You cut services. You defer repairs. You stop taking certain tenants. You try to raise fees elsewhere. Or you sell. That's what benefit reductions, premium increases, and plan withdrawals really means. Now, here's the data point that actually matters inside this entire story, the medical care ratio. I told you earlier I'd reveal the one specific chart or data point that proves why this collapse is inevitable. Here it is. The medical care ratio jumped to 88.9% from 85.5%. That is the proof. Because an insurer's entire economic model is the spread between what it collects and what it pays out. When that payout ratio climbs, you can't AI your way out of it fast enough. You can't marketing campaign your way out. You can't spin it. You either get paid more or you pay out less. And Washington just told you you're not getting paid more, at least not the way you expected. So the market did the only rational thing it could do in the short term. It took the multiple down. That's why you saw a 21% move. And that's why this is bigger than UnitedHealth. Now let me add the layer most people don't want to talk about, utilization behavior. We are in a world where delayed care from the COVID period has been working its way through the system. Analysts have already noted that the sudden rise in healthcare activity among seniors, especially in Medicare plans, pushed costs higher and hurt profits. When utilization rises, the MCR rises. When MCR rises, margins compress. When margins compress under policy constraints, the only outlet is plan design and footprint reduction. That is not a one-quarter phenomenon. That is a year digestion. And then you add the trust tax. Change healthcare hack, estimated revenue impact of $799 million. The DOJ investigations into Medicare billing and Medicaid discrepancies. These are not just issues. They are costs. They are distractions. They are future settlements. They are compliance spending. They are political risk. Markets hate political risk because it is not modelable. And when risk becomes unquantifiable, capital demands a higher return. That means a lower price. Now, here's the new open loop. Because if you think this is the worst part, you're not seeing the full board. But this isn't even the worst part. What is happening right now in the Medicare Advantage reimbursement regime, combined with sector-wide utilization creep, is the final nail in the coffin for the easy growth narrative across managed care. And that matters because managed care was a stealth pillar of U.S. equities. It was one of the places where large institutions parked capital for stability plus growth. If that pillar becomes volatile, it changes portfolio construction. And when portfolio construction changes, the flows change. And when flows change, prices can stay irrational longer than retail investors can stay solvent. UNH Day reportedly dropped sharply after hours on the 27th of January 2026, moving from €302.20 to €237.80, down 21.31%, with elevated volume that signaled active rebalancing. By funds and traders, price moved below the 50-day and 200-day averages, the kind of technical break that triggers systematic selling. This is what the public doesn't understand. A lot of selling has nothing to do with belief. It's mechanical. It's rules-based. It's risk-based. It's model-based. So the question, is it a buying opportunity? Can't be answered emotionally. It can only be answered with scenario thinking. Which brings us to the verdict. I'm going to give you 3 scenarios: best case, worst case, and what I'll call the institutional case, the way long duration capital will likely position around this. And I'm going to be very careful here. This is not financial advice. This is a framework for thinking like the people who move markets. Scenario 1, the best case, the compression, then the rebound. In the best case, the 0.09% proposed Medicare Advantage increase is the low point of the negotiation, not the final number. The industry lobbies the model is recalibrated, and we end up with something modestly better than feared. Utilization begins to normalize as the post-COVID catch, upwave fades. The medical care ratio stabilizes and gradually improves as plan design changes catch up. Optum margins stop deteriorating and begin to expand as management tightens execution. AI helps, not as magic, but as operational leverage, faster approvals, cleaner payments, fewer friction costs. In this world, the 21% drop becomes the market's overreaction. The stock finds a floor, multiples stabilize, and long-term holders who bought into fear are rewarded. This is the world where the phrase palpable momentum becomes real, and the company's stated long-term growth target, 13% to 16%, remains credible. Scenario 2, the worst case. The policy squeeze plus utilization spiral. In the worst case, the 0.09% isn't a negotiating anchor. It's the new posture. Washington signals that Medicare Advantage will not be allowed to expand profitability at the expense of federal budgets. Reimbursement stays tight. Utilization remains elevated because the senior population is not just growing, it's aging into higher cost years with more chronic complexity than the market models assume. The medical care ratio remains high or rises further. The company responds with benefit cuts, premium hikes, and deeper county exits. Enrollment growth stalls or reverses in key geographies. Meanwhile, regulatory scrutiny intensifies. DOJ investigations expand. Compliance costs rise. Settlements become a possibility. Management spends time defending instead of innovating. In this world, the 21% drop is not the bottom. It's the first leg of a longer day rating, because investors stop paying for certainty. Scenario 3. The institutional case. Volatility becomes the asset. Now, here is the case most people don't see because it doesn't fit into a simple bullish or bearish story. Large institutions rarely bet on a single outcome. They build portfolios that survive multiple outcomes. In this case, the conclusion isn't UnitedHealth is over or UnitedHealth is a steal. The conclusion is healthcare is entering a new phase where dispersion matters. Meaning, within the same sector, some companies will compound and others will decay based on regulatory positioning, operational efficiency, and balance sheet flexibility. In this world, the BlackRock case is about managing exposures, not making heroic calls. It looks like this. 1. You respect the pulley by regime. You stop valuing Medicare Advantage businesses as if reimbursement is perpetually generous. You demand a margin of safety. 2. You watch the medical care ratio like a hawk because it is the heartbeat of the model. If MCR stabilizes and improves, you can underwrite recovery. If it keeps rising, you reduce exposure. 3. You focus on cash flow resilience. Earnings can be managed. Cash flow is harder to fake. Strong free cash flow conversion buys time, funds buybacks, and absorbs shocks. 4. You accept that volatility creates entry points, but only if you size it correctly. The wealthy don't all in on a falling knife. They scale. They build positions over time as uncertainty resolves. So what should you, as a viewer, actually do to protect yourself? Here's the solution, and I'm going to make it practical. First, stop thinking in single stocks if you don't have institutional tools. If you're not reading regulatory proposals, tracking utilization data, and modeling scenario ranges, then your edge is not stock picking. Your edge is diversification, fees, and time. Second, understand your exposure. Most people don't realize how much of their broad market portfolio is quietly exposed to a handful of mega caps and a handful of policy-linked industries. If healthcare volatility rises, it can affect your index experience more than you expect. Third, watch the two numbers that matter more than any headline. Number 1, medical care ratio trend, not 1 quarter, trend. You are buying exposure to a policy-regulated cash flow machine whose profitability depends on reimbursement math and utilization behavior, 2 things you do not control. The market just reminded you of that. So here's my final truth, the one the mainstream won't say out loud. This wasn't just a UnitedHealth story. This was a demonstration of how quickly a certainty can become a debate. And when certainty becomes debate, money moves from the impatient to the patient. The world is changing. If you want to be on the winning side of this wealth transfer, you know what to do. Subscribe.